Okay, then why are 30-year yields higher? 30-year treasury yields higher. It's not growth. It's because there's some feeling of inflation. And you look at inflation expectations, it's the same dynamic from a longer term perspective. So again, listen, those that have made money in Bitcoin in 2021, God bless. In Dogecoin in 2021, God bless. In Rocket in 2021, God bless. In NVIDIA this year, God bless. I keep going back to, you can make a lot of money in manias. The question is, can you keep it?
What's going on, everybody? We have Michael Guyad. He's a CFA charter holder. He's a portfolio manager. He's been on my show a couple of times. Today's not really like we don't have the scheduled questions. We want to make it very conversational here. Now, he's a rules-based portfolio manager, Row, Jojo, ATAX. He's a 5 times Dow and Founders Award winner. He's the publisher of a lead lag report. If you haven't checked that out, check out his research there. He gives out so much data. He hosts numerous amounts of interviews too, which is mind-boggling. And he has quite the personality on Twitter, or I should say, X.
Somebody used a term from like WWE kayfabe, right? When it comes to that persona that people see on Twitter and X, and it is a persona, and it does work because I do get the reach. But everything I say, I do believe in, right? So as much as I'm having fun, for example, with the NVIDIA insanity, I believe it's in trouble as a stock, not necessarily as a company, because the two are very different. But a lot we can talk about. But it's always important to emphasize that nobody knows what tomorrow brings, persona or not.
I want to kick off just kind of starting with one of the main topics you've been talking on Twitter, your thought process here on NVIDIA. And really, I mean, we just reported earnings and everyone was super stoked because it jumped up. And well, today it's trading down. Well, I mean, it's taking quite the reversal today.
Yeah. Okay. So look, I've been on this whole NVIDIA is, without using the word, right, is in trouble. Right? I've been using that term since before the earnings gap up, when everybody started poking fun at me being wrong on that. And clearly I've still been wrong because the stocks kept on going up, although the vast majority of other stocks haven't, right? I mean, one of the things I was sounding the alarm on was that we were getting into a narrower breadth, right? That what's happening with NVIDIA is more a symptom of a bigger problem in terms of intermarket dynamics. I'd argue just looking worse and worse, with that being here's the birdie, right? Now, I have no idea what the hell is going to happen in NVIDIA. Nobody does. I do know for sure that narrative follows price. So what was the narrative entering this morning? They blew out on earnings and revenue, and they're going to keep on skyrocketing. And people were saying that because, after hours yesterday, it was up like 10% or whatever the number was.
Yeah.
Right. So, but here's the thing. It's like, okay, so no disagreements that the company's been on fire at all. But what's that worth? Right. And for how long? It's like, you can't say that the company's doing incredibly well while the PE keeps on expanding like it's going to be, the only company left, which, by the way, it probably is going to be the case given how a lot of these zombie companies are just not performing in the small cap space. So to me, this is no different than any other mania. You have people chasing. There's no disagreements that it's not like crypto in the sense that this is a real company with a very real revenue, with a very real value proposition. But there's a price for everything. There's a value for everything. So you can't just say, revenue is blowing out, but then the PE goes to 1,000. Like, there has to be some perspective on this. Now, again, I have no dog in this fight. To me, this is more just comical with NVIDIA. I always say don't short. I always say don't do puts. You can observe something as a symptom without participating in it, right? And I really do believe that, I keep saying, it's like AI is not going to save us from a credit event. There's so many other things happening beneath the surface, which I would argue are much more imminent, real, and present dangers than missing out on the FOMO trade of this one stock.
Yeah, I was listening to your Wealthion interview, and you said something that kind of resonated with me, and it was you were talking about risk management, and you said, if you want to be up over time, you need to be down less. And it's something so simple, but you just mentioned short selling. And if you I've noticed this in my trading, if I take away things that I, just remove them completely from my trading that have hurt me the most, I do significantly better.
Yeah, no, I think that's right. And it's also easier said than done in practice. Like I use that line repeatedly. To kill in the stock market, you have to not get killed.
Right.
I got killed not in the stock market. I got killed in treasuries, right? With the rules-based funds they run, because their expression of risk off is treasuries. Now, I'm going to keep emphasizing this point because I do believe in the transparency that is missed by a lot of people on Wall Street. At the end of the day, I'm biased. My bias is not to be against NVIDIA. I just think it's funny. My bias is not to be a perma bull or perma bear. And it's funny because people think I'm a perma bear now when they seemingly called me a perma bull back in October when I said melt up is coming, right? Last year. My bias is I want to see the flight to safety trade. I want to see that sequence where treasuries counter equities, right? Which would happen with credit spreads widening, which would happen with, real stress and volatility. That creates a movement back into long duration treasuries, which this week are actually having a pretty big week. May have finally shown some signs of life here. Entering September, which is anyway one of the worst months, if not the worst month on average historically, right, from a seasonality perspective. So I am hopeful that the idea of being down less will, at this point in the cycle, matter for my rules-based funds, because to be down less, the way to express that is by not being in equities. It's actually by being in treasuries, because at least you have a chance at making money and being wrong. And if treasuries do counter equities this time around, okay, great. I mean, people underestimate. I built a whole career on this phenomenon of the flight to safety trade with these signals, right? I mean, I created funds around this very specific dynamic where there's convexity in treasuries when you get that risk off period. It's like, long duration treasuries TLT as your proxy, right? Historically, when they outperform equities, right, it's like a VIX spike. It's like having exposure to the VIX without the risks of the VIX from the decay. So long duration treasuries relative to equities can beat equities by 2,000, 3,000, 4,000 basis points in a matter of weeks. I'm saying that because that's fact historically. So, to wrap it up, NVIDIA is still in trouble. Okay. But the broader point here is risk management matters more than FOMO in the long term. But even if you have that mindset, you still have to have the opportunity to play ball with you.
Gotcha. And I know there's a lot of technical chartists that watch my channel. So it's going to be really important for those that do like looking at the charts to pay attention to NVIDIA's close on a big gap up like this. And you got to really think, if it was really good earnings, but we closed down or at the lows of day, this could be known as an exhaustion gap, which could mean a potential reversal in the price of NVIDIA. I want to get into...
And by the way, sorry, and by the way, those earnings can keep on improving. It's like, okay, so if you were to cut NVIDIA's price by 50%, it's actually still fairly richly valued, fundamentally, right? And you still have to keep on hitting very strong numbers for that momentum to continue from a fundamental perspective. Now, some people say fundamentals don't matter. Okay, they don't matter until they do, right? It's like, it's just funny to me. There's a disconnect. People reference fundamentals and earnings and revenue on an absolute basis without even considering what the existing stock has priced in, which is something which is almost impossible to achieve, right, in terms of forward-looking expectations. So, not to beat a dead horse, but it's like, be very careful. This isn't about fundamentals. This is about FOMO. And if it's about FOMO, FOMO is very well known to have crashes. And it could be that NVIDIA ends up being the source of liquidity if you have a credit event.
Interesting. What are your signals telling us right now? So we've already mentioned 5 times Dow and Founders Award winners. I know lumber to gold is a big one, the beta rotation strategy. Any insight into what they're telling us?
Yeah, I mean, the main one now actually to watch for the kind of more shorter term quick switch is utilities, which on a relative basis look like they're really starting to firm up, and that tends to happen in advance of a corrective period. Also, this time, for the first time in a while now, long duration treasuries relative to intermediate. So if you use ETFs like TLT versus IEF, that's now starting to also maybe pick up and bottom out. So I do think that those signals are telling you we're getting, again, so I keep saying September, we're getting to a point where there's some positioning that's taking place, right, in advance of, maybe a high risk setup. The lumber to gold had a pretty big spike last week. I suspect that's going to be faded. So that signal probably flips back to, risk off in a couple of weeks. But I keep going back. It's like all this is lining up for September. I posted it repeatedly for like, several months saying October, right? And it's not because I think something's going to happen this October. It's because I think there's a real chance that you break the October lows of last year. Okay. I don't know what happens in September, right? But it goes back to this whole thesis that the bear market's not over. And I got to tell you, since you talk about chartists and technicians, any 5-year-old chartist, any 5-year-old technician can pull up a chart of the Russell 2000, use IWM as your proxy.
Yeah.
And in that 5-year-old voice say, "Mommy, Daddy, that is not a new bull market." Any 5-year-old chartist or technician living in their parents' basement that talks about squiggly lines can pull up a chart of emerging markets and tell you, "Mommy, Daddy, that's not a new bull market." So it's like, I really do believe this. I think people are being deceived by themselves. There's a degree of self-deception here in the narrative around new bull market, and everything that I myself keep pointing out, which is fact. It's not my opinion. Most things have sucked this year on a relative basis against the S&P. So you break NVIDIA, you break the Magnificent Seven, which is typically what happens anyway at the tail end of a bull move. Yeah, suddenly, there's an air pocket.
I wanted to actually get into small caps and kind of ask you what story are they telling right now? Because they haven't moved. They've literally gone sideways. I mean, I remember them doing this for a long time. I think it was, what was it,
2021?
Yeah, they just went sideways.
Right, with the precursor large cap bear market.
Yeah, so they just kept on going sideways. Yeah, but what is the story there? And I mean, they've come off this month about around 7.5% or so. So do you see some sort of reflexive just bounce and to potentially trap more people? Is anything pointing to that, or is it see you later, small caps?
Yeah, I mean, it's a really good and really important question, right? So it's like, what was the narrative at the start of the summer? Right, there's going to widen. What happened to that? Forget about even small caps. You look at the percentage of stocks trading above their respective 200-day moving average in the NASDAQ. It's getting worse and worse. Like, the breadth is getting way worse now, right? Just as everyone was hyping up improvement of breadth. Now, small caps have been wildly frustrating. Wildly frustrating. Okay, so I've got a mutual fund ATAX, rules-based. Okay, so it's trying to play a risk on based on signal and risk off based on signal, equities and treasuries. But there's this relative momentum component, either trying to relatively trade small caps or relatively trade emerging markets against large caps. And it's been whipsaw city, right? And when did that start? It started around the March regional bank crisis, right? A lot of the sideways chop, right? Which has been very violent, actually. It looks like you're going to break out, but these like huge swings where it's like 1 or 2 weeks. If you get them wrong, it's like you're going to have negative returns, which is really what's happened with my mutual fund. Unfortunately, Roro and Jojo don't have the same dynamic. But I think it's a very ominous sign. Now, at the start of the year, when I said, it's going to be a melt-up year, but there's a credit event out there, my thesis back then in January was, at some point, investors start to worry about all these zombie companies that have to roll over their debt into higher rates next year, and that the broader stock market would start to anticipate that this year, towards the end of the year. My whole thesis around the credit event was actually around the corporate refinancing, right, which is primarily these levered small cap companies. I suspect that's probably why small caps are not able to get off the ground, because they need credit availability more than anybody else, right? Just because they're smaller by nature, they have less resources. So I look at what's going on small caps. I say to myself, all right, that's sending a really big warning sign, right, for not just the broader market, but the broader economy. And again, it's not a new bull market unless you have real participation. Like I keep using that line, a rising tide lifts all boats. That's usually the line that people say. It's like, well, a rising tide, when it doesn't lift all boats, drowns everybody. This is like I said, there's a self-deception, I think, that's happening in the marketplace. And that's not me being a perma bear. It's just clear as day when you look at the way certain charts, as a chartist, observes these things, right? So I'm sure you see something not that dissimilar, right, in terms of the divergence of small caps, the divergence of emerging markets, and now the strengthening of defensive sectors. Yeah. Not too many people are properly prepared. They're just being distracted by NVIDIA, me included, by the way.
Yeah, it's funny, the whole AI kind of narrative. I mean, the AI, you would think that small caps would technically benefit from that, but they just haven't. So
yeah, that's really there's so many. It's like, yeah, but I keep. No one has yet to give me an answer to this. I keep saying if AI is disinflationary, which I think everybody agrees with, right? AI is not going to be an inflationary phenomenon. It's going to cut out labor. It's going to make things more efficient, right? We can all agree that that's the cause and effect of AI. Okay, then why are 30-year yields higher? 30-year treasury yields higher. It's not growth. It's because there's some feeling of inflation. And you look at inflation expectations, it's the same dynamic from a longer-term perspective. So again, listen, those that have made money in in Bitcoin in 2021, God bless. In Dogecoin in 2021, God bless. Income rocket in 2021, God bless. In NVIDIA this year, God bless. I keep going back to, you can make a lot of money in manias. The question is, can you keep it? Right? And that's where I would just get people to try to not pound their chest, but rather just be careful.
When you mentioned credit events, and I want to kind of really just dumb this down as much as we can for just a regular person that, maybe not like could turn on CNBC, and that might be a little bit over the head sometimes. What is something that just everyday people can potentially look at? Maybe it's a chart of something specific, or what can they just have access to tell us, hey, things might be getting a little out of hand or out of control right now, or things are starting to get a little bit better.
Yeah. Okay, so let's. Credit event is the exact same as a massive VIX spike.
Okay.
So if you were to look at the VIX and you overlay option adjusted credit spreads, differential basically between junk debt and AAA, right? Poor quality and high quality debt. The overlay is pretty much 1-for-1, meaning when you get credit spreads widening and blowing out, it coincides with a VIX spike because the bond market perceives volatility as risky in terms of default potential. And there's kind of a self-fulfilling feedback loop there too, because if credit spreads are widening, default risk is increasing, right? Bond investors for these highly levered junk issuances say, you know what, I need more yield in case the company doesn't make it. And that creates all kinds of ripple effects on what it implies for equities more broadly, right? So, I mean, the simplest one is the VIX. The thing is, you can't necessarily time the VIX except at extremes for mean reversion. It's not really sort of a, that's like the mile marker you might crash your car, I'd argue, is the VIX as a level. Another way to look at it is to look at something very simplistic. Just look at, JNK or HYG, those junk debt ETFs relative to nominal 7 to 10 year treasuries. Okay, slight duration mismatch, right, with IEF, but as a proxy. But if you see high yield starting to underperform nominal treasuries, that would mean that there's a repricing also of default risk, right? As junk debt underperforms quality, which is strange to call the U.S. government debt side quality, but they have a damn army, so I'll call them quality, right? So those are the two things. It's not something that, it's not me saying that you're going to have an end of the world situation where credit spreads are going to blow out and then you got mass bankruptcies, the perma bear argument, right? It's just bear markets tend to end with a bang. Bear markets tend to end with credit spread blowouts. Recessions tend to start and end with credit spreads, right? So I actually very much look forward to a credit event, aside from the fact that, candidly, I need it, right, to have a chance for my funds to capture the flight to safety trade in treasuries. But if you're going to be a long-term investor, don't you want to pick up some nice corporate credit that's yielding like 15, 20%? Which would happen after a credit spread blowout? I'm blown away how people don't, they should be rooting for this so they can load up on the eventual overreaction.
Yeah, I mean, a lot of opportunities take place if you're prepared. And what I like about your process and some of the things that you say is, one, you're not saying, okay, go ahead and short it. What you're saying is take your foot off the gas a little bit and be prepared for when the opportunity starts coming back.
Right. Exactly right. And this is why I always go, I get it. I'm sure a lot of people on your channel are doing shorting, and I think you are as well, right? God bless. Again, if you can make money on it, great. I'm very skeptical from a backtest perspective that anybody can successfully short longer term, because there's too many whipsaws, right, around being wrong. Better to, like using your analogy, take your foot off the gas. So all the papers basically show that the best outperformance being defensive over time is lowering your beta. So utilities, consumer staples, healthcare, get defensive while still being equities. That way, if you're wrong and the market goes higher, you're still equities. If you're right, you're going to lose less. Goes back to that point about losing less to really kill it. And then treasuries themselves, because now there's positive carry because yields are a lot higher. Long duration treasuries. Now, it's going to be interesting. So there's been this huge short positioning from a spec perspective on long duration treasuries. You're entering September, which is historically the worst month for equities. You've got everyone seemingly forgetting that China is decelerating. They all talked about it last week. Nobody's talking about it now. Right? The attention span of everybody is like a flea, right, in terms of macro conditions. And yeah, I keep going back to the reverse carry trade is the real Mothra. It's the real butterfly, right, to watch out for big effects. So contrarianism does not mean you bet against the crowd. it means you're betting on something that has a higher expected value where few other people are betting. So if everybody's shorting treasuries, they could keep on making money and be right. But by definition, betting that long duration treasury yields fall, right, when very few people are actually betting on that, probably means you have a higher payout, even if the probability is lower, because you're not splitting the pot among so many different players, right? So to me, it's more of a mindset thing, but we'll see. Listen, I could be totally wrong. And I keep going back to, if I'm wrong about a credit event, I would not apologize, because why would I apologize for something when I'm clearly identifying, and nobody can counter me on this? I haven't seen any rational arguments that counter the idea that the conditions are worsening.
Yeah, and it's just data.
Just data.
It's just data.
The persona, the way that I frame it gets attention, right? Because I'm playing with the algorithm. Yes, folks, I am doing that because I'm an entrepreneur, right? And you have to get reach to get people to pay attention to you, and then hopefully see your services when the cycle comes your way. But again, I believe everything that I'm saying, and it's not based on some random like frustration. It is based on data. I'm just framing it in a way that gets attention, and hopefully that's comedic.
Triggers people. It is what it is.
Let them be triggered. Listen, you can be triggered all you want. Honestly, people should be triggered. What it's funny, like, what does that mean to trigger somebody? It means you're pushing them out of their comfort zone and pushing them to not fall for confirmation bias.
Yeah.
Because people are triggered by the things they don't agree with, no matter how mundane it is.
Yeah, exactly.
Right. So yeah, you know what? You should be triggered. I would argue to you that's exactly what you want.
Yeah. All right. I want to close off with talking about Jerome Powell. He's coming up tomorrow. We'll see if he gives us any insight. He seemed pretty reluctant on the last meeting to give like future guidance. Seems like he's holding that very tight. And then I want to talk about how rates are, we're talking about holding rates higher for longer, what that potentially can mean for the economy. And then also the yield curve inversion kind of became a distant thing. The 10-2 still inverted, the 10-3 month heavily inverted since, the 80s or something like that. So what are your thoughts?
Yeah, no one cares about the yield curve until stock prices go down.
Yeah, true. And then all of a sudden it's obvious.
And it's like, oh yeah, yield curve was always right. And then they say, well, yield curve predicted 9 out of the last 5 recessions. Listen, every time you slow down when you're driving, you're making a prediction that you're going to crash. That doesn't mean you shouldn't slow down just because you didn't crash. It's like you still have to pay attention to the precursors, even if it doesn't have a 100% track record, right, in the small sample. Okay, so I have no idea what Powell is going to say or do or think. I suspect they're in a really weird spot, right? I think they want to be done with rate hikes, but at the same time, the pace of the shelter side is, I think, giving them a lot of pause, right? Because housing's reaccelerating and housing's inflationary, right? And I've been wrong on the housing timeline. I thought it would happen sooner, the breakdown, but housing is, you can argue, a problem for the inflation story. Okay, so probably has to be very careful here because they may want to pause rates, but they may have to still hike rates. But then you have this other dynamic where they hike rates and the banks get even worse in terms of their asset liability mismatches, right? So you'll see even more community banks and regional banks probably go under the higher and more aggressive they get. So I do think there's no good choices here. They may have to keep on raising rates, but any sort of incremental new hike in rates might mean, it all comes collapsing down, right? So yeah, the lack of transparency would probably be the best thing for them now, because the last thing they want to do, I'd argue, is also whipsaw public expectations.
You mentioned banks, and that's one thing that I forgot to even bring up, but people that are paying attention to the financials right now, I mean, they've been actually getting clobbered this month, kind of under the radar, but Citigroup was a big one that just created new lows, lower than when the whole SVB bank blew up. And then obviously the Fed stepped in, which I guess is just a form of easing the bank term funding program. Yeah. Anything else that you want to add? Where can people find you?
Yeah, so at Lee Lagerport on X, Threads, Instagram, YouTube, also with the channel, and I want to get you back on Space also to return the favor, right? Post those videos, but no, I think your point is very important. Now, I've written articles arguing that financials probably start to outperform tech, which sounds weird because if you're a credit event, how would that be the case? It's a relative trade. I keep going back to there's a very well-known phenomenon called the disposition effect. Okay, so what the heck is the disposition effect? There's all kinds of studies that show that when faced with uncertainty and volatility, people do not sell their losers first. They sell their winners. They're disposed to sell the securities in their portfolio that have the biggest gains when there's uncertainty, when there's volatility, when there's fear. There are not that many big winners. We know what they are. We know NVIDIA is one of them. So, you could have a situation where you have a credit crisis, but financials, oddly enough, outperform on a relative basis those stocks, while a lot of these other Magnificent Seven tech names end up being sources of liquidity, because behavior would suggest they sell them first, not the banks, when there's volatility, even if it is a credit event, as I suspect it will. So I think this whole environment's going to be very tricky. I encourage everybody to follow Mr. Silva and, of course, subscribe to his YouTube channel, right? And the only thing I can suggest to people is don't fall for crowd confirmation bias. Think for yourself and allow yourself to be triggered, because it might get you to think.
I like that. Mike, thanks again for coming onto the channel. Would love to have you back here in the near future.
Unequivocally. Appreciate it, man.